Hello all, this is Keerthana, Assistant Professor, Department of Commerce. So today we can see an lecture series on the subject Direct Tax Law and Practice. So in so far videos we have seen many about direct tax, assessment year, previous year and salaries and everything. So now we can see what is let out house and self-occupied house, which comes under the income from house property. So first we can see this presentation will actually deliver about definition, tax implication, key distinctions between self-occupied and let-out house property along with recent tax updates. So first we can see what is self-occupied house property. So first thing is, for personal use, a residential property exclusively used by the owner or their family for living purposes. So next is nil annual value. So the annual value for tax computation is considered nil, assuming no notional rental income. So in multiple properties, up to 2 properties can now be claimed as self-occupied under recent tax rules. So while coming to tax benefits, deductions on home loan interest which are up to 2 lakhs and principal repayment is up to 1.5 lakhs are available. So what is let out house property? So in rental income, any property rented out fully or partially during the financial year. So while coming to taxable income, rental income is taxed under income from house property. And in deemed let out, properties beyond 2 self-occupied homes are considered let out even if it is vacant. So full interest deduction, all home loan interest paid can be claimed as a deduction with no upper limit. In tenant management, it requires active management of tenant, agreement and maintenance. So in tax computations for self-occupied property, gross annual value. So these are all we have seen in our problems, right? Gross annual value, expected rental value and municipal rental value, fair rental value and everything. So while coming to gross annual value, there is no notional rent is considered for tax purposes. And in municipal taxes, deduct municipal taxes actually from GAV. So we have to deduct the municipal rental value from gross annual value. Next is home loan interest. So in home loan interest, deduction can be capped up to 2 lakhs under the section of 24 subsection B of the Income Tax Act. And in principal repayment, deduction up to 1.5 lakh under section 80C combined with other eligible investments. So for computing the let out property, first is gross annual value. So actual rent received or expected reasonable rent, whichever is higher. So in municipal taxes, deductible from gross annual value to arrive at the national annual value. And in standard deduction, flat of 30% of NAV, which is net annual value, is allowed as a standard deduction for repairs and maintenance. And while coming to home loan interest, full amount paid is deductible with no upper limit. So in the note, I have to convey this is, any loss from house property can be carried forward for 8 assessment year and to be set off against future house property income. So now we can see the recent law update of budget. So before only one self-occupied property was allowed to have a nil annual value for tax purposes, or any additional residential properties owned by the taxpayer were redeemed to be let out even if they were vacant in the previous. But now under the updated regulations, taxpayers can now claim up to 2 properties as self-occupied, both having nil value. So this applies even if the owner cannot occupy them due to employment or business elsewhere. So before the taxations, only one self-occupied property will be allowed to have a nil annual value. But in the updated version, we have 2 occupied properties can be self-occupied without annual value. So benefits and considerations. So for self-occupied, let out or both. we can see the benefits and consideration. So while coming to self-occupied, no tax on notional rental income, and also limited interest deduction up to 2 lakhs capable, and no passive income is generated. While coming to let out, rental annual income is fully taxable. Full home loan interest deduction is no capacity, and also generates passive income. Next is requires tenant management. While coming to both the common rule is principal repayment deduction under section 80C, which is up to 1.5 lakhs. So while coming to conclusion, first we have to classify the data into proper and accurate data. And next is record keeping. So maintain meticulous records of rent, municipal taxes and home loan payments. Next, utilize deductions. So leverage available tax deductions to significantly lower your tax liability. And coming to end, seek professional advice. So take that advice from tax professionals for complex situations or properties. So hope the video was useful, and hope you have understood the topics. Kindly visit again to check the before and after tax payment systems. So this will be helpful for the updation of your current affairs. Thank you.